Chapter 4, Financial Forecasting. Chapter 4 Outline. What is financial forecasting? Pro forma income statement, cash budget, pro forma balance sheet, percent of sales method, summary, and conclusions. Learning objectives. Explain. Explain why financial forecasting is essential for the healthy growth of the firm. Prepare. Prepare the 4 financial statements for forecasting the pro forma income statement, the pro forma statement of retained earnings, the cash budget, and the pro forma balance sheet. Learning objectives, Part 2. Perform. Perform the specific accounts method and the percent of sales method for forecasting on a less precise basis. Determine. Determine the need for new funding resulting from sales growth while giving consideration to seasonal and other effects on cash flow. Calculate. Calculate the required new funds, R&F, and sustainable growth rate, SGR. The financial planning process. Financial forecasting is looking ahead to develop a financial plan. Very important for the strategic growth of a firm. Provides lead time to make necessary adjustments before actual events occur. Helps to plan for significant growth in firm. Can be used as a target for measuring performance. Often required by bankers and other lenders. The financial planning process involves the following steps: thinking, decisions, planning, and performance. Constructing pro forma statements. A systems approach to developing pro forma statements allows construction of a pro forma income statement based on sales projections and a production plan, a pro forma statement of retained earnings, a cash budget from inflows and outflows of cash, and a pro forma balance sheet. So we start with the prior balance sheet, then we have a sales projection, then we do a production plan. Those feed into our pro forma income statement, and that also feeds into our cash budget and our pro forma balance sheet. And our other supportive budgets, like capital budgets, feed into our cash budget, and then our cash amounts are closed into our pro forma balance sheet. Pro forma income statement provides a projection of how much profit the firm anticipates making over the ensuing time period. Involves the 4 following steps. 1. Establish a sales projection in dollars and units. 2. Determine a production schedule and the associated use of new material, direct labor, and overhead to arrive at gross profit. 3. Compute other expenses, including indirect labor, supplies, and other costs. 4. Determine profit by completing the pro forma statement. Bases for sales projections. External factors: recession or boom, export sales, consumer spending, competition, new technology, etc. Internal factors: new product lines, turnover in people, profit targets, employee training, price changes, etc. Table 4-1, projected wheel and caster sales, first 6 months, 2000 XY. We have quantity times by the sales price to give us our sales revenue for both product lines. So we have them individually and total. Table 4-2, stock of beginning inventory. We have our total quantity multiplied by the cost to give us our total value, and we add both of those product lines together to give us a total. Production or purchases schedule. Projected sales in units or dollars plus desired ending inventory minus beginning inventory equals our production requirements. Table 4-3, production requirements for 6 months. So we have our projected unit sales of 1,000 plus our desired ending inventory of 100. Subtract out our beginning inventory, which was the previous month's ending inventory of 85, to give us our units to be produced for 1015. So that's for wheels. For casters, we have 2,000 plus 200 minus 180 to give us 2,020. Table 4-4, unit costs. So you have your materials per unit, your labor per unit, and your overhead per unit. You total those up for each of your product lines, and then you have your total unit costs. Table 4-5, total production costs. So you'll take your units to be produced that we calculated in table 4-3 and multiply that by your cost per unit from the previous table, and that gives you your total cost. And just add up both product lines and then get a total as well for total production costs. Table 4-6, allocation of manufacturing cost and determination of gross profits. So you have your quantity sold times by your sales price to give us your sales revenue. And this is for each production line and then combined. Then in cost of goods sold, we have our old inventory, our quantity in units, times by our cost per unit to give us our total. And then our new inventory is our quantity in units times by the cost per unit to give us our total. And our total cost of goods sold is then subtracted from your sales revenue to give you a gross profit for wheels of 12170 and for casters for 26360 for a total gross profit of 38530. Table 4-7, value of ending inventory. So we have our beginning inventory plus our total production costs. That gives us our total inventory available for sales. You minus your cost of goods sold, and that gives us our total ending inventory of 6,200. Pro forma income statement, June 30th. So we start off with our sales and then subtract our projected cost of goods sold to give us our projected gross profit, minus the selling and administrative expense to give us our earnings before interest and taxes, minus the interest expense to give us our earnings before tax, multiply that by the tax rate to give us our earnings after tax. And the change in retained earnings is the common stock dividends declared of 1,500, and that gives us an increase in retained earnings for 18,524. And so all of these pro forma statements are exactly the same as the regular financial statements that you've done in previous chapters, except we're just working with make-believe numbers, not the actual numbers. That's what pro forma means. Cash budget. Identifies cash shortage in advance. Forecasts amount available for major expenditures. Basis for arranging financing. Shows ability to repay debt. Suggests possible changes in plans, delay capital expenditures, try to speed up collections, or reduce expenses. Table 4-9, monthly sales pattern. So we have monthly sales for the 6-month period, January through June. Table 4-10, monthly cash receipts. So with this company, our sales are when we sell the product, but our cash is when we actually collect the cash. So in this case, our collections are 20% in the current month. So for January, you would see 20% of 15,000. That's how we got the 3. And then they have 80% of the previous month's sales. So then if I see the sales for December is 12,000, if you multiply that by 80%, then that's how you get the 9,600. So then you add up all of your collections in that month. So that's the 3,000 and the 9,600. and then you get total cash receipts of $12,600. So each company is going to have their cash collected in a different time frame. So each question that you work on will have a different percentage and a different collection method than just this scenario. Table 4-11, component costs of manufactured goods. So we have our materials, labor, and overhead. We have our number of units produced times the cost per unit to give us our total cost for both product lines and combined. Table 4-12, average monthly manufacturing costs. So materials, the average time frame is 6 months. So we're just taking the total cost divided by the time frame. So our average monthly cost is 5,732 if we have to do the budget on a monthly basis. Labor, total cost is 17195 over a 6-month period. So monthly it's 2866. And overhead is 11125 over 6 months. So our average monthly cost is 1854. So each question again will be different. You have to pay attention to the total cost if it's for the year or maybe for a quarter, which is 3 months, or in this case, semi-annual, so that's 6 months, and then try and find the average monthly cost. Table 4-13, summary of all monthly cash payments. So we'll use January as the example. Our monthly material purchase is 5,732. Our payment for material in the prior month was 4,500. Our monthly labor cost is 2,866, and our monthly overhead is 1,854. Our general and administrative expenses spread over 6 months is 2,000 each. And so then our total payments for January is 11,220. But just pay attention in the other months, there's extra costs. Like for example, when we record interest in June, tax payments. So you might not have to make a tax payment every month. So you just put it in the month that you have to make the payment. When you're planning on paying a cash dividend, put it into the month where you're paying the dividend. When you're buying new equipment, put it into the months that you're planning on buying the equipment. So in this case, it's February and June. Table 4-14, monthly cash flow. So you take your total receipts for each month, subtract your total payments for each month, and then that gives you your net cash flow. Table 4-15, cash budget with borrowing and repayment provisions. So in some cases, you have to take your opening balance and then you add to that your net cash flow to give you your cumulative cash balance. And some companies want to keep a buffer in their bank account. So for this situation, it's saying we always want to have 5,000 in our bank. And after 5,000, you'll have to borrow money. So if it's lower than 5,000, you have to borrow money to bump it back up to 5,000. And if it's higher than 5,000, then you can repay some of the money that you borrowed. So for this example, let's just look at February. We have our net cash flow. So minus 6,452 means that we're planning on spending that much in February. Our beginning cash balance is 6,380, which was January's ending cash balance. So when we add those two together, we're short by 72. So since we have to have 5,000 in our bank account at all times, I have to borrow 5,072 to bump me to 5,000 in my bank account. So if I'm looking on my bank, like online, I would see 5,000 on my bank account for 5,000 in cash, and then a loan against that for 5,072, which ends up being that 72 minus. Pro forma balance sheet shows the anticipated cumulative changes in a firm's asset holdings and liabilities and equity account over the next time period. It's constructed from the prior period's balance sheet and pro forma income statement and the cash budget. Table 4-16, balance sheet, ASPE. So you still have your balance sheet items. What I would do is I would just have the balance sheet from the previous year, which is the actual figures, and then you would put in little slots. So whether or not you want it to be on a monthly basis or a yearly basis or at the end of your pro forma statement, then you would go and link all of these into its category. So these are just all of our pro forma amounts. Figure 4-2, development of a pro forma balance sheet. So prior balance sheet, unchanged items, marketable securities, long-term debt, common stock. So those are only unchanged if we're planning on not buying or selling any securities in the future, if we're not planning on buying or repaying long-term debt, and if we're not planning on issuing or repurchasing any of our common shares. So those could be changes with a different company, but for our purposes, we're just going to pretend that those aren't changing. Then we have our pro forma income statement analysis, which comes from our inventory and our retained earnings. So we already figured out what our retained earnings would be and then what our new inventory balance would be off of all of our estimates. And then our cash budget analysis links into our cash, accounts receivable, plant and equipment, accounts payable, and notes payable. And all of those link into our pro forma balance sheet. So our pro forma balance sheet for our ASPE format. So the first balance sheet I showed you was the actual one. Now this one is the pro forma one. So you take those numbers and you add and subtract any changes that came from any of those pro forma sheets that we just did. Percent of sales method. Here's a shortcut. It's less exact, but it's an easier method of determining financing needs. It assumes balance sheet accounts will maintain a constant percentage relationship to sales. More sales will mean more assets, which will require more financing. It can be summarized by using the required new funding R&F formula. Table 4-18, percent of sales table. So if we just look at here, we have 200,000 in sales and then our percent of sales. So you can just do 5 divided by 200 to give you the 2.5%. The 40 divided by 200 to give you the 20%, and so on. Percent of sales method. The formula to determine the need for new funds, required new funds, or R&F. R&F is spontaneous increase in assets minus spontaneous increase in liabilities minus increase in retained earnings. So in table 4-18, sales increased by 100,000. So applying the R&F formula, so A is your assets divided by S1, so those are your original sales, times that by triangle S, that just means the change in sales. Then you minus your liabilities divided by your S1, those are your original sales, and multiply that by your change in sales. And then minus your profit margin percentage, that's what P stands for. S2 is your new sales, and then 1 minus D is the dividend payout ratio. So A divided by S1 is 60%. The change in sales is 100,000. The LS1 is the percentage relationship of liabilities varying with sales to sales. P is the profit margin of 6%. You can either get that from the income statement or the question will tell you. S1 is your existing sales, S2 is your new sales, and D is the dividend payout ratio. Again, it'll give it to you or you can calculate that. Percent of sales method example. In table 4-18, the 100,000 sales increase required new financing of 26,000. So we have 100,000 of assets increasing times by the 60% to give us 60,000. Minus the 100,000 of liabilities increasing times by the 25% to give us minus 25. Then minus the increase in retained earnings. So 300 is your new sales times 6%, which is your profit margin percentage, times by 1 minus 50%, which is your dividend payout ratio. So that's 9,000. So your required new funding is 26,000. So that means that we need to borrow 26,000 if our sales are going to increase by the amount that we want. If this shows up as minus, then that means we actually have extra cash. Sustainable growth rate, SGR. The maximum rate of growth achievable without increasing the debt ratio. The sustainable growth rate, SGR formula is SGR equals change in sales divided by sales, where DT over E is debt to equity ratio. And for our purposes, we're not going to have to calculate the SGR rate. Table 4-19, R&F with sales expansion, percentage of sales method. So what we've done now is we looked at the balance sheet before. Now we're looking at the balance sheet after with our sales increase. And because we needed to borrow $26,000, so that's the number coming from our R&F calculation, I'm going to put that into notes payable. Now, if we ended up having excess cash, what I would have done is decrease my notes payable, and if I had any extra cash left, then I'd put it into my cash account. Table 4-20, R&F based on SGR. Summary and conclusions. Financial forecasting is used to anticipate events in advance, particularly a need to raise more money for the business. A complete forecast would include a pro forma income statement, a cash budget, a pro forma balance sheet. Summary and conclusions, part 2. The basis for most forecasts is the sales projection. Simplified forecasts can be prepared using the percent of sales method. The SGR and R&F formulas provide insight on the impact of sales growth on funding requirements.